Coca-Cola is one of the most recognizable brands in the world, synonymous with refreshment and global reach. But how strong is the company behind the iconic red label? Beyond its branding power, Coca-Cola's financial strength can be assessed through detailed valuation techniques. From its revenue streams to its market position and long-term sustainability, Coca-Cola presents a fascinating case study in corporate success. In this analysis, we'll use financial valuation techniques to uncover just how strong Coca-Cola is, and what lessons investors and businesses can draw from its strategies. Coca-Cola's strength begins with its unparalleled brand equity. The company operates in over 200 countries and offers a portfolio of beverages that include Coca-Cola, Sprite, Fanta, and Minute Maid. The diversification of its product line extends to water, coffee, and sports drinks, ensuring resilience across various consumer segments. Revenue generation is a cornerstone of Coca-Cola's financial strength. In 2022, the company reported annual revenue exceeding $43 billion, a testament to its global reach and pricing power. The company's franchise model allows it to generate steady income while minimizing operational risks by delegating bottling and distribution to local partners. Key performance indicators such as operating margin and return on equity consistently reflect the company's efficiency and profitability. For example, Coca-Cola's operating margin regularly exceeds 20%, demonstrating its ability to maintain high profitability despite challenges such as inflation and supply chain disruptions. Another factor underpinning Coca-Cola's financial robustness is its ability to command premium pricing. Consumers often perceive Coca-Cola products as higher value due to the brand's reputation, allowing the company to maintain healthy profit margins even in competitive markets. Valuation insight. Brand equity, market penetration, and operational efficiency form the bedrock of Coca-Cola's financial strength, making it a consistent performer in the global market. Coca-Cola derives its revenue from two main sources: concentrate sales and finished product operations. Concentrate sales, which involve selling syrups and concentrates to bottling partners, contribute a significant portion of its profitability due to their high-margin nature. Finished product operations, which involve direct sales of beverages, provide volume-driven revenue. The geographical diversification of Coca-Cola's revenue streams is another critical factor. While North America remains its largest market, regions such as Asia-Pacific and Latin America are rapidly growing, driven by rising disposable incomes and expanding distribution networks. To understand the company's revenue potential, it's crucial to examine volume growth. Despite industry challenges like shifting consumer preferences toward healthier options, Coca-Cola has adapted by introducing zero-sugar variants and acquiring health-conscious brands like Honest Tea and Costa Coffee. Coca-Cola's ability to innovate within its product portfolio has also been instrumental. The introduction of smaller portion sizes, for instance, addresses consumer concerns about calorie intake while maintaining profitability through premium pricing strategies. Additionally, the company's partnerships with major food chains and entertainment venues ensure steady sales across various channels. Valuation insight. A diversified revenue model, both in terms of products and geography, underpins Coca-Cola's ability to sustain growth and weather market fluctuations. Financial ratios provide a clear lens through which Coca-Cola's financial health can be evaluated. First, the price-to-earnings or PE ratio. Coca-Cola's PE ratio typically hovers above the industry average, reflecting strong investor confidence in its stable earnings and growth potential. Next, the debt-to-equity or DE ratio. While Coca-Cola maintains a higher-than-average DE ratio due to its strategic use of debt for acquisitions and shareholder returns, its strong cash flow ensures debt servicing is never an issue. Then, the current ratio. Coca-Cola's current ratio remains steady around 1.0, indicating efficient short-term liquidity management without excessive capital hoarding. And then, the return on assets, or ROA. The company's ROA is consistently robust, reflecting its ability to generate significant returns on its asset base, a critical indicator of operational efficiency. These ratios highlight the company's balance between leveraging financial strategies and maintaining operational stability. Additionally, Coca-Cola's dividend payout ratio, consistently above 70%, signals a commitment to returning value to shareholders, a factor that bolsters investor trust. Coca-Cola's exceptional cash flow management deserves special mention. Its free cash flow consistently exceeds $7 billion annually, enabling the company to fund dividends, share buybacks, and strategic investments without compromising financial stability. Valuation insight. Robust financial ratios demonstrate Coca-Cola's ability to balance growth with shareholder returns, making it a reliable investment choice. Coca-Cola's growth strategy revolves around three pillars: product innovation, digital transformation, and market expansion. The company has invested heavily in data analytics to understand consumer behavior and optimize marketing strategies. Partnerships with e-commerce platforms have also enhanced its ability to reach consumers directly. Sustainability is another cornerstone of Coca-Cola's strategy. Initiatives such as the World Without Waste campaign, which aims to collect and recycle one bottle or can for every one sold by 2030, demonstrate the company's commitment to environmental responsibility. These efforts not only reduce operational risks, but also enhance brand loyalty among eco-conscious consumers. Emerging markets present significant opportunities for Coca-Cola. With increasing urbanization and a growing middle class in regions like Africa and Southeast Asia, the company is poised to capture new demand through tailored marketing and localized product offerings. Coca-Cola has also embraced technology to drive growth. Its freestyle vending machines, which allow consumers to customize their beverages, showcase the company's commitment to innovation. Additionally, digital campaigns targeting younger audiences have boosted brand engagement across social media platforms. Valuation insight. Strategic focus on innovation, sustainability, and emerging markets ensures Coca-Cola remains competitive in an evolving global landscape. To determine Coca-Cola's intrinsic value, a discounted cash flow (DCF) analysis is instrumental. By projecting future cash flows and discounting them to present value, we can assess whether the company is overvalued or undervalued in the stock market. Key inputs for the DCF model include revenue growth rate. Analysts project steady growth in the range of 3 to 5% annually, driven by innovation and market expansion. Weighted average cost of capital (WACC). Coca-Cola's WACC typically falls around 6 to 8%, reflecting its stable risk profile and access to low-cost capital. Terminal growth rate. A conservative terminal growth rate of 2 to 3% aligns with global GDP trends and Coca-Cola's mature market position. Preliminary DCF calculations suggest Coca-Cola's intrinsic value aligns closely with its market valuation, underscoring investor confidence in its long-term prospects. Adjustments for sensitivity scenarios, such as lower than expected revenue growth or higher WACC, still position Coca-Cola as a fundamentally strong investment. Valuation insight DCF analysis confirms Coca-Cola's strong market positioning and aligns its intrinsic value with market expectations. While Coca-Cola remains a strong performer, it is not immune to risks, health trends. Growing consumer awareness of sugar consumption poses a challenge, necessitating continued innovation in healthier beverage options. Regulatory risks. Taxes on sugary drinks and stricter advertising regulations could impact sales in key markets. Macroeconomic factors, currency fluctuations, inflation, and supply chain disruptions can affect profitability, especially in emerging markets. Competitive pressures. The rise of regional beverage brands and health-focused startups intensifies competition, requiring Coca-Cola to continuously adapt. Coca-Cola's proactive approach to these challenges, including diversification and investment in healthier products, mitigates these risks effectively. Its focus on water neutrality and renewable energy usage further strengthens its position in a market increasingly concerned with sustainability. Valuation insight. While risks exist, Coca-Cola's adaptive strategies position it to navigate challenges successfully. Coca-Cola's financial strength, driven by its iconic brand, diversified revenue streams, and strategic initiatives, underscores its resilience in an ever-changing market. Through detailed financial valuation techniques, we see a company that balances growth with stability, innovation with tradition, and global reach with local relevance. For investors and business enthusiasts, Coca-Cola offers a masterclass in sustaining relevance over decades. Its ability to adapt, innovate, and deliver consistent returns makes it a standout in the corporate world. How do you view Coca-Cola's financial strength? Share your thoughts in the comments, and don't forget to like, subscribe, and hit the notification bell for more deep dives into the world of business and finance. See you in the next video.